If you're a retail investor, I'm sure you've heard of Mr. Warren Buffett, widely considered to be the GOAT, the greatest investor of all time. Now, his company, Berkshire Hathaway, has put up some of the most insane investment results over the last 20 years. I'm talking thousands of percent, a huge amount of wealth generated for investors. Now, what would you do if I told you that Canada actually has its own Berkshire Hathaway and that Canada's is outperforming Berkshire Hathaway itself? Welcome to Golden Arch Investing. My name is Liam. Today, we're going to be talking about Fairfax Financial. It's Canada's version of Berkshire Hathaway, a massive company that is in the financial space, making a huge amount of value for shareholders, and of course, a huge amount of long-term potential built in thanks to the structure of the business. Very similar to Berkshire Hathaway itself, this company has worked to acquire and build just one of the most insane financial services business that there is. And of course, the stock results are pretty fantastic. So today we're going to go through the company a little bit, and then we're going to cover some analysis on whether or not this company is a great buy now. So starting off on an overview, we're using Fiscal.ai here, great service. And we can see that Fairfax Financial, through its subsidiaries, provides property and casualty insurance and reinsurance and investment management services in the US, Canada, Asia, and internationally. They operate through insurance and reinsurance, runoff and non-insured company segments, insures against losses to property from fire, explosion, earthquake, windstorm, flood, boiler explosion, machinery breakdown, and construction defects, as well as underwriting auto, commercial, and personal property and crop insurance. So the insurance business is really the name of the game here. Very, very similar to Berkshire Hathaway. And this is a crazy business. When you look at some of the metrics that we're going to look at, they make a huge amount of money from this, and it has provided them a huge amount of opportunity. Now, if you go down, the name of Canada's Berkshire Hathaway leader, sort of our little Warren Buffett here, is a guy named Prem Watsa, very famous investor, very, very skilled. He's been leading this company for a while. This company was founded in 1951. So it is an old company, but again, like Berkshire Hathaway, had seen some insane growth, and I would even call it parabolic growth over the last couple of years. We scroll down, we see this is actually quite a large company in the Canadian market. We're looking at a $52 billion market cap, revenues of $36 billion. It's got a PE right now at about 10. Looking forward, staying just about flat. Valuation next 12 months looks at Fiscal.ai here, almost called them FinChat again. They're looking at a price target of $2,400. They have $6 billion cash on hand, $5.7 billion in net debt. If you look at some of the compound growth rates over the last 5 and 10 years, you're sitting at about 14. Diluted EPS, you're sitting, actually kind of a crazy number there. Obviously, there's a story to be told when you look at 131% diluted EPS 5-year growth. But if you just cancel that one out, you look at the 3 and the 10 year there, you're looking at about 14. Good numbers. Over the next few years, they're expected to increase their earnings per share by about 8% a year. The long-term growth estimate is up at 15. So here's where this company became really interesting to me. As a Canadian investor, a lot of the things I buy into are sort of overlapping fields. I've got my banking, I've got my energy. We're huge investors in oil and gas on this channel. We believe strongly in those areas. But a lot of the companies we invest in are generally slow growth, somewhat boring dividend payers. But this gives us a different look on that same equation, because these guys, while they might be what you consider a boring stock, insurance and reinsurance, how often is that going to make headlines? Their growth metrics still outperform the overall market. And I'm not talking by a little, I'm talking by a lot. And this is the part where you see real performance. I scroll down here, I've got a chart laid out for the last, we're looking at 34 years. So a long period of time here. And we see Fairfax Financial in purple, the S&P 500 in orange, and we see Berkshire Hathaway itself in green. And look at this chart, guys. Look at the outperformance. Okay, S&P 500 is up 2,400%. So you 24 times your money in the last 34 years. Berkshire kills it, 10,667%. So now we're talking, 100 times your money? Fairfax Financial is at 34,000. Look at the separation they've built. Now, if I zoom the chart in, you're going to see this difference maybe, change a little bit. If I pull this and we just look maybe the last 25 years, well, now you're seeing Fairfax is up 1,800%. Berkshire's up 1,200%. And you're seeing the S&P at 500. If I even pull it back shorter, I go to 2010. And I'm looking at just maybe the last 15 years. Much tighter. But every time Fairfax is coming in the lead. Last 10 years, Fairfax is leading. Last 5 years, Fairfax is leading. There you go. So on every time frame, Fairfax Financial has outperformed, and it's brought a huge amount of value to investors. The few percentage points they've been able to consistently and long-term gain, so that that 1-2% gain every year over the SPY, means that if you hold this for the next 20-30 years, you could be looking at tens of thousands of percent gains, because this is not a business that relies on any sort of short-term movement or that has any sort of big short-term weaknesses. Fairly diversified, and obviously it has the scale to put up with almost anything. Now, anytime we talk about a business like this, we can always dive into the numbers, but one of my favorite things to do is to see what people who really understand this business are saying about it. So we're jumping over here to Seeking Alpha. You see on the screen, I've got Nicola LaPena. I think I'm saying that right. Fairfax Financial Holdings, misunderstood conglomerate with some upside. You might be asking, what does he mean by misunderstood? Well, I want you to think back to that stock chart we were just looking at. Fairfax Financial has destroyed just about any other security over the last 20-30 years. So at some point, you're going to have to ask, is this overvalued? And I think that's become the real conversation around Fairfax. Every time I see people mention this company, they're talking about one or two things. They're either saying, hey, are these guys going to buy this asset or this thing? And second, they're saying, hey, is this overvalued? How can something go up by so many hundreds and thousands of percent and still be good value? That's usually the conversation we see. And quite often you see people saying, nah, Fairfax is overvalued. You're paying too much. And sometimes on short-term timeframes, they might be right. But on a long-term time frame, I think you see the real value. So let's see what Nicola has to say for us. Fairfax Financial Holdings is a cautious buy due to its diverse asset mix, strong insurance growth, and undervaluation versus peers. Company benefits from higher interest rates, robust investment performance, and disciplined underwriting, despite catastrophe risks like wildfires. Global investments keep its valuation below pure play peers, but continued growth and transparency can help close the gap. And they expect steady book value growth, share buybacks, price target of 2,500 Canadian dollars by the end of the year, supported by proven leadership and capital strength. Intro. Fairfax Financial is cautious buy today given their diverse asset mix, growing core insurance business, and undervaluation from a peer's perspective. The FFH on the TSX is a Canadian insurance and financial services company with operations globally. Company's core competencies include property and casualty insurance, reinsurance, and investment. Fairfax Financial has a book value of $1,060 as of the writing of this article. As of December 31st, so actually before the writing of this article. It includes business segments divided by industry, notably insurance, investments, and others. Given the earnings split on both insurance and investments are similar, I think investors are cautious and don't quite understand the business, hence the discount in book value per share. They've had a strong past 12 months, rising over 50%. I think some gains can continue in this volatile trading environment. While the bond market has seen yields rise over the past couple months, I think Fairfax Financial can continue to outperform from an investing standpoint, as long as their insurance business continues to grow even close to the 10% plus we saw in 24. I think Fairfax can close the book value per share gap with peers towards 2x by end of 25. With a base case book value per share of $1,250.25 in line with their estimate of 15% growth, I can see the stock up to $2,500 before year end. So basically there's two things in that story. They're saying that the peers of this company, so other insurance, reinsurance businesses, trade at about 2 times book value, and that this author thinks Fairfax should also trade up there, which I guess it did not, but close to. And they also expect that 15% growth to happen. So they're basically saying that they want this thing up at $2,500, and they think it's reasonable based on that book valuation. In Canada, the company operates mostly through its property and casualty insurance subsidiaries, providing coverage for both personal and commercial clients. The U.S. Fairfax Financial has a more diverse insurance presence, offering a range of specialty insurance products through multiple subsidiaries. Firm's international operations focus on general insurance solutions tailored to local markets with selective involvement in reinsurance and specialty lines. But it depends on the country. Outside of insurance, Fairfax Financial manages a significant investment portfolio with investments in public equities, fixed income, and private business across sectors. Unlike traditional insurers, the company combines underwriting operations with investment-driven returns, making it a unique hybrid conglomerate not too dissimilar from Warren Buffett's company. The company has continued to drive strong performance with operations in a hybrid conglomerate type structure, similar to Berkshire Hathaway. Again, this is kind of why we're talking about this, because there's a Canadian Berkshire Hathaway that's undervalued, crazy. Industry and competitive analysis. Here's the real value when you take these articles from specialty investors. I'm not going to call all of them analysts necessarily, but they are specifically focused on their few core stocks. And as people who invest in the Canadian market more broadly, we can see each of these individual people and we can read deep knowledge, like serious insight into these companies. This is part of the reason why I don't necessarily cover like Morningstar analysts that often, because a lot of those people are the same kind of zoomed out investors we are. We have our hands in multiple pies. These people who write these articles are very focused on the specific companies they cover. So let's talk about their industry. They have diversified revenue streams, including global property and casualty insurance, reinsurance, and investment operations that position the company well to capitalize on a higher interest rate environment. Unlike life insurers, Fairfax Financial Canada benefits more directly from higher rates through improved yields on its fixed income portfolio and wider underwriting margins. Historically, higher 10-year bond yields have expanded net investment income across Canadian insurers, and Fairfax Financial is well positioned given its longer duration bond portfolio and equity investments. Around 70% of the company's income over the last several years has been boosted by investment performance. Coupled with good underwriting growth amidst their global footprint, Fairfax Financial stands to benefit both from core insurance profitability and from improved returns on invested assets in the current macroeconomic climate. Company's key public competitors include Intact Financial, Definity Financial, who just acquired the Canadian operations of the Travelers for a book value of 1.4x, which I think will lead to meaningful synergies for Definity Financial. Additionally, I added Berkshire as a competitor given a similar conglomerate structure with significant P&C insurance exposure, though noting its scale over 20x Fairfax Financial. So you compare some of these. If you look at the PE on a GAAP basis, trailing 12 months, you see how Fairfax Financial is significantly undervalued. They're looking at about 9.5 compared to their peers. If you're looking at EV to sales, again, significantly undervalued. If you're looking at price to cash flow, significant undervaluation every time for Fairfax Financial. Recent Q1 results. Their investment division has a solid Q1 with lots of action. One big example is the stake in Eurobank, one of Greece's larger financial institutions. Stock has rocketed upwards over the last 5 years to the point where its market value versus book value of the share is actually contributing about 4% discount to Fairfax Financial's equity. Crazy. While stabilizing European macro backdrop and improving bank fundamentals, the company thinks it offers embedded upside as the bank's fundamentals and valuation catch up with the broader EU banking sector. While the company only holds 32% of Eurobank, to me, this is a classic reason why Fairfax has a smaller PB multiple. Investors here don't really care or understand much about these minority stakes in other geographies and may prefer to just hold that stock specifically. Additionally, Fairfax Financial owns almost half of Poseidon, a global logistics firm that provides financing and other help to the shipping industry. Analysts pressed management on the recent earnings call about Poseidon, but management noted that with long-term contracts backed by financially strong customers with outstanding balance sheets, they're confident Poseidon will weather the storm of trade volatility. On the insurance side, biggest story in Q1 was the LA wildfires. The company reported $692 million in wildfire-related losses, near the upper end of management's prior guidance range of $750 million. Despite this, the consolidated combined ratio clocked in at 98.5%, highlights the underwriting business mostly held up despite the storms. Stripping out catastrophe losses in prior year development, core accident year combined ratio is now 89.5. Means beneath the volatility of potentially one-off events, Fairfax is building meaningful underwriting discipline, which I hope will provide clarity to instructors. So basically, they knew this could happen. They were prepared. Risk profile. Company's operations protect it from single market shocks, but two key risks come top of mind. First is catastrophe exposure, given the climate crisis and continuing. LA wildfires this past quarter underscore the vulnerability of the business. The loss, though within guidance, but the high end clipped the consolidated combined ratio. Though these losses are usually looked at non-recurring, global climate shocks continue to happen more often, could lead to profit declines. The other large risk I see is valuation volatility. The company has made some savvy long-term investments. I think concentrated bets and select names are always going to lead the company to have a smaller multiple. Another thing management talked about in the last earnings call was the potential boat rocker Blue Ant Media IPO. Will likely value accretive investors don't always get the different equity moves, and that is the reason conglomerates have declined. Equity investment exposure leads to book value sensitivity for market swings. That said, company remains disciplined in capital allocation, continues to reward long-term holders through consistent share buybacks and strong long-term outperformance. Fundamentals. Forecasted target share price is modeled using price to book, given the complexity of its various operating segments of a conglomerate. Historically, Fairfax Financial has about a PE of 10, slightly below its peers given its large scale and confusing operations. That said, though, according to LSEG, the company is better scored on valuation than its peers and is trading at a discount to its trailing PE. So basically, if you look here, you look at where Fairfax is trading, right? Everything looks more positive for them compared to their peers. Also agree with this author's sum of the parts valuation from a recent article on Fairfax Financial Canada. Notes the stock is trading on the low end of an estimated range of 1.4 to 2.2 times price to book. Don't disagree. Fairfax Financial will never get a pure play multiple 2+ like their Canadian P&C peers. Think they continued improving growth in the underlying business, along with clear reporting of wins in global equity, they can close the gap as uncertainty persists. So cautious buy today. Expect strong book value growth, share buybacks. Given the proven execution globally and well-capitalized structure, succeed in the later half of the year, see the multiple expand slightly. I think it probably won't repeat the crazy 24, but it should trend towards $2,500. Okay, so let me give some thoughts here just before we close out this video. Why should you own this stock? Well, there's a couple reasons. One, if you need exposure, or you want exposure to that investment and reinvestment business, it is a crazy high cash flowing business that provides a lot of value. Some of Canada's best companies are investment businesses. We have a lot of big ones here, and Fairfax Financial sits as probably the best because of what else it holds. That being the undervaluation thanks to its confusing structure. It's really hard to talk about companies like this. Berkshire Hathaway is only really well understood by the market because of who runs it and how well they've done historically. Fairfax Financial is a smaller company, dramatically smaller, and it's Canadian. It does not have the same kind of name brand appeal, and so it sits at a quite low sort of valuation when you think about it. Again, it is lower than most of its just pure play insurance peers, even though I would argue that the structure of this company, giving it more diversity, giving it more long-term potential, should give it a higher valuation. I would be paying a premium for something that also holds on to really interesting equity investments, that has significant exposure to the different bond markets, that has significant capacity to continue growing on multiple vectors. That gives me more hope in the long-term performance. And while investors might be discounting the company for that, I think they should give it like actually more value. I also think that it is an opportunity to get into some of the long-term parts of your portfolio. When you think about your investments and you think about the time horizons you're willing to hold them for me, I have a lot of investments right now that I sit on for the next 5-10 years, but I don't have a lot that I expect to last 30 plus. I think Fairfax is on that list. I think it's up there with the large Canadian banks where you could literally buy this and hold this forever. It is unlikely to get disrupted. It has a very wide moat and it has fantastic leadership. Now, those things can change in that long period of time, but historically done quite well. And while right now might not be the time to lump sum into the company, considering their incredible performance, I think a dollar cost average entrance would make a lot of sense for most investors, considering what you're looking for and if you're going to hold this long term. Now, I would love to hear your thoughts in the comments down below. Are you buying this company? Are you interested in it? Did I sort of open your eyes to what this company looks like? Or are there other companies in the same kind of space that you'd rather own? Again, let me know in the comments down below. If you've watched this far in the video and you like it, please do like the video. If you're interested in this kind of content, please do subscribe to the channel. And as always, I hope I see you in the next video.